Welcome to Get Started Investing, a show that helps you make the most of your money. In this 12-part series, we're sharing everything that we've learned about investing to help you get started or to remind you of why it's so important. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Excited for this episode. We've covered the basics, why you should invest, how you can be investment ready, the importance of improving your savings rate. Now we get to the investing side of stuff.
Yes.
The fun starts now.
That's it. So in today's episode, you're going to learn what is the share market, what is a share, and what does it mean to own one, and then the different styles of investing.
Love it. Well, let's start with what is the share market. And I think for this, let's use an example company to illustrate the point.
All right.
Let's say we give up podcasting. It's
Yep.
been fun. We're sick of looking at each other.
Yeah.
But we decide we're not sick of working together. So we start the Equity Mates Cafe.
Okay.
We'll still actually be looking at each other a lot. We're sick of talking to each other. So we're making coffees, you're making brownies and pastries in the back. Customers are coming in the door, and you and I own the company 50-50.
Yep.
So the first thing to establish is a company can be divided into shares, into ownership shares.
Yep.
Pretty simple.
Pretty simple.
Let's say things are going well, but we start bickering a bit. I think the customers are coming because the
coffee's
so good. You think it's the brownies that are bringing people in. Eventually, we decide we can't work together, and we agree that I'm going to buy your shares out and run the cafe myself.
Yep.
So the second thing to establish there is that shares can be bought and sold.
Yes.
And really, at its core, that's all you need to understand the share market. Because beyond all the flashing lights and the charts and the jargon, all the share market does is facilitate exactly what we've just explained.
Yes. But if you were to try and go out onto the street and sell those shares in the Equity Mates Cafe to some random passerby, it would be quite difficult.
If you, rather than selling your cafe shares to me, you wanted to sell them to someone else, and you just were hitting up customers as they were coming in, that is a slog.
I'd kill the business, but customers would get incredibly pissed off. But it'd be slow, time-consuming, and very hard to do because I don't know who's a buyer out there.
And then you find someone who's interested. How do you figure out what the price should be?
Exactly. Yeah. And so the share market really takes away those difficulties because it provides a place where buyers and sellers come together and they can sell and trade shares incredibly easily. In most instances for large companies, almost instantly. And you can do it at a price where that is agreed almost instantly as well.
And so we said there were two things that you need to understand. The second one was that shares can be bought and sold. And as you said there, that's kind of what the share market facilitates, a place where buyers and sellers can meet. But the first thing was also that companies can be divided into shares. And that's why companies go to the share market. They say, we want to raise money to, open a second cafe location, and we're going to divide ourselves into more shares and sell those shares to investors to get the money to then go and open cafe number 2.
Yeah.
And it's a confusing place. It's a place that moves quickly and is full of jargon. But at its core, if you understand those two key things, you understand the share market.
And we're going to talk about how to get access to the share market through brokerage platforms a little bit later on in this series.
So then the question becomes, so that's what the share market is. What does it mean to own a share? If we take it away from the Equity Mates Cafe that we own shares in, and we actually talk about, owning shares in Woolworths or Coles.
Well, you kind of spelled it out in the example of Equity Mates Cafe, Ren. It's you're owning a share of that business. You and I, because we split it 50-50, you and I own half of Equity Mates Cafe. You can get access to the biggest businesses in the world through the share market and have a small percentage ownership of the business. But just because it's a small percentage ownership doesn't mean you're any less of an owner.
Well,
true. There are some nuances.
You are less of an owner because you have a smaller percentage.
But the good news is you are entitled to what that business spits out, which is hopefully a profit. And so just because you own a small share of it doesn't mean you don't get a share of the profits of the business. So owning shares means you're an owner of the business and you're entitled to the profits of the business.
Yeah. So in the cafe example, we are entitled to profits that the company makes. And because we each own half, we're each entitled to half of the profits. But also we make decisions together,
Yep.
and we have all the responsibility of owners of the business. When you own a share of Woolworths, it's exactly the same in the sense that, as you said, you're entitled to the profit, but you also help make decisions. It's just the fact that you're like 0.001% of the ownership structure. Your voice doesn't carry a lot of weight when they're making decisions.
Exactly.
But if you over time bought like 30% of Woolworths, you would have a lot of say in the decisions as well.
Absolutely.
So whether you own a share of a local cafe or whether you own a share of a company listed on the share market, conceptually, it's exactly the same.
Yeah. And just think about that. And it's like, again, from your bedroom, you can be an owner of Apple, of Meta, of Google, these incredible businesses that are out there trying to make money for you as a shareholder.
Yeah.
It's pretty amazing.
Yeah. I think in our first episode, we spoke about how we enjoyed coming up with business ideas and, we gave a few a crack and none were that good. But at the same time, we were learning about how you can invest in the businesses of others.
Yeah.
It becomes really exciting to think, we could take our money and start a food business where we sell food to uni students who are working late at the library after all the food options have closed on campus. Or we could take our money and invest in Tesla.
Yeah.
And like the range of businesses that are, or like the range of opportunities for you to put your money to work is a lot larger.
Yeah.
But at its core, whether you start the food business on the ANU campus or you invest in Tesla, like either way, you're putting your money to work in businesses which, employ people to work hard, to sell things and create new products to make you as a shareholder more money.
Yeah, so good. Now, there's some jargon that's thrown around when it comes to the share market. Well, really, it's just the interchangeable shares, stocks, equity. It's all the same. So don't get confused if you're hearing someone say I'm investing in stocks versus I'm investing in shares, or the stock market, the share market, the equity market. It is all the same thing.
Yeah. Yeah, it's ownership stakes in businesses.
Yeah. So that's what a share market is. That's what a share is. But now it's how do you start investing? And when you sit down and I maybe type into Google or start reading books, you're going to come across different styles of investing that experts sort of talk about as being the best way to invest in the stock market. Now, there are plenty of ways that you can make money, and there are plenty of different styles of which we're going to go through right now.
I think that point is just worth dwelling on for a second, because I know when I was starting to invest, I felt like I had to do the work to figure out the right way to invest.
Yeah.
And you would read conflicting views from different experts, and you would feel like one's right, one's wrong, and it's incumbent upon us to figure out who is right.
Yeah.
And figuring that out is really going to determine if you're a successful investor or not. Forget that mind frame. There are a lot of people that make money in very different ways in the share market. There's not one correct way to invest. We would argue some are better than others, but more importantly, some suit different temperaments better than others.
Yeah.
And so we'll talk about a number of different styles, but I think the best investors draw from all of them.
Yeah, yeah.
So let's start with the biggest distinction in investing, which is active versus passive investing.
So passive investing is where you really make no investment decision. You buy and you hold that asset. That's it. If we put some examples to it, you buy a block of land or a farm, for example, owning a painting, Picasso, or even owning an index ETF, which we'll talk about in a little bit more detail later on. These are all assets that you're putting money in and then you are just letting sit and letting the value of that increase, hopefully, over time.
Yeah, farms are probably a confusing example because farms are often you're working in them. But this is, owning a Picasso is a classic example. You're not buying or selling it, over time. You're not trading. You're not doing anything to the Picasso to make it more valuable. You're just buying and holding it. That would be
interesting if you try and add a few.
add a few brush strokes, yeah. And there are people who just buy and hold passively in the share market. That's the majority of our portfolios.
Yeah.
And we're going to explain why we think that's a great base for your investments over the coming episodes. So, but that's one type of investing, passive, and then the other is active.
So active is where you actively make an investment decision. It's where you're buying and selling at different times. You're choosing which assets to bring in and out of your portfolio. You're more involved in the decisions in your portfolio.
Yeah. Now we're going to take a quick break here, and then on the other side, we're going to unpack the 3 most common types of active investors and how you can distinguish each of them.
Investing has helped me travel, it's helped me have new experiences. So simply put, investing helps me enjoy my current life, but it also sets me up for my future life.
What motivated me to first start investing, I think, was just to try and make money. Like, actually just make money and get rich.
One piece of advice I'd give my friends or family to start investing is to just do it, because it's easy. Serious, just listen to this podcast.
Welcome back to Get Started Investing. We're talking about the different styles of investing. We spoke about passive versus active. And there are different ways and different styles when you look at the active side of things, Ren.
Yeah, so there's 3 that we want to talk about. Value investing, growth investing, and momentum investing. And the reason that we've chosen these 3 is you're likely to hear about them as you're learning how to invest. And it can be confusing to try and figure out the differences between them. So we want to try and unpack them as simply as possible. With the reminder that we said before the break that none of these are right or wrong. They're all different, and people make money pursuing them, each of them. But it's just important to understand how different people approach the market.
Yeah.
Because one person's great idea could be another person's terrible idea.
Yeah.
And it can be confusing to say, well, is it a great idea or a terrible idea? But it could be both because they're different styles of investors.
Yes.
Yeah. So let's start with value.
Yeah, value. And I think for you and I, this is where it probably started when we were in our early investing journey because of Warren Buffett and Benjamin Graham, these guys that, were hard value investors. What is value investing? It's really trying to buy $1 for 50 cents, going out there and trying to find something that is less than what it's worth and buying it, hoping that it then comes back to what you perceive its value to be.
Yeah. And back when Warren Buffett started investing, and we actually haven't done a lot of intro to Warren Buffett content in this series, but Warren Buffett is, I would argue, history's greatest investor. Over a 60-year track record, he generated incredible returns, 5.5 million %.
Yeah.
And he's just got very down-to-earth, simple insights that really help people understand investing. Because he's become so successful and so popular, a lot of people resonate with value investing. Value investing's changed a lot from when he started out. When he started out, you would find a company that owned, for example, $100 million worth of land, but was trading at $25 million on the share market.
Yeah.
And so that was the classic value investing play where the things that it owned, the assets that it owned, were actually less than what people were paying for it on the share market.
More.
Yes. The share price was less than the assets.
Yes.
Yeah. Thank you. These days, because of the amount of market information and the amount of investors out there, those opportunities are less prevalent.
Yeah.
Like there's just less of them because if there were there, people would buy them.
Up, yeah.
But there's still plenty of examples where people try and find value. And one might be, to use an Australian example, and these aren't real numbers, but this is how value investors might approach the opportunity for investing. They might look at Wesfarmers, which is like a big Australian conglomerate, owns a lot of really well-known companies. And they might say, well, Wesfarmers is valued at 90 billion Australian dollars at the moment. But if we look at the companies that it owns and we add them up, that's actually worth more than $90 billion. You might say Bunnings is worth $60 billion and Kmart and Target together is worth $20 billion and Officeworks is worth $20 billion. So that alone adds up to more than 90 billion.
Yeah.
And we haven't even talked about its industrials and safety and chemicals and lithium business.
Yeah.
So you say, in this instance, I'm buying $1 for less than $1.
Yeah.
Yeah.
So obviously a lot of work goes into trying to find those companies. You have to actively be involved and doing the work. But that is at its core what value investing is. And you will find that some people are just value investors and it ebbs and flows because there are times in the market where this doesn't really work as well. Then there are times when it really does work. But yeah, up to you whether it's right for you, but that is value investing.
So then that leads to the second style of investing that you'll hear often about, growth.
So it's all in the name. It's buying something that you think you will be able to sell for more. you're finding an underlying business that you reckon is just going to grow and that you paid $1 for, and I'm going to be able to sell it for $2. And that's it.
Yeah.
It's pretty straightforward.
An Australian example that's had pretty incredible growth recently is Pro Medicus. Now, its share price is up 600% in the past 5 years, but the underlying business has grown incredibly. Now, it's a medical imaging software company, and it's grown well in Australia, but the story gets really exciting because it's grown quickly in America. A lot more hospitals are using their software. So it's a company that is growing, and then the share price has grown as a result of the company growing.
Yeah.
So that's growth investing.
And I think really that's what most people probably think value investing makes the most sense, but in reality, they invest in a growth way. Even if you think about, buying your first house or buying property or whatever, everyone's doing it with the expectation that it's going to go up.
Yeah. And then that leads to the third style of investing that we wanted to talk about, which is momentum.
Yeah.
Now, this is looking for the momentum in the share price, how the share price is moving. It's a little bit more short term. It's a little bit more tactical. But I think really importantly, the distinction between growth and momentum is growth looks at the underlying business.
Yep.
How's Equity Mates Cafe going? How is it growing? Is it expanding to more locations? Is it selling more brownies? Whatever it is. Whereas momentum doesn't look so much at the underlying business, but it looks at the share price.
Yeah.
And it says, what's going on with the share price? Are there more and more buyers coming into the market? Are people getting excited about it? Is it getting more buzz? And they look at things like charts. They look at the volume of buyers and sellers. They look at the share price itself. And they're less concerned with how many brownies is Equity Mates Cafe selling, and they're more concerned with how many people are trying to buy shares in Equity Mates Cafe.
Yeah. And there are a number of tools and platforms online that allow you to find that information. But again, it's really understanding if it is the right investment approach for you.
One example from 2025, a really notable momentum investment was Drone Shield. Now, this is a counter-drone technology company, and it absolutely ripped. It was up 950% between January and October. Investors almost 10 times their money. And the business wasn't changing that quickly. The business didn't 10 times their revenue in 9.5 months.
Yeah.
But momentum was crazy. More and more people were piling into the stock. There were so many more buyers than sellers. And so momentum traders tried to ride that momentum.
Yeah.
The important thing, if you're thinking about momentum, is that momentum turns.
Big time.
And it can turn hard because from October to the end of the year, it lost about 2/3 of its value. It's down about 66%.
What a ride.
Yeah. And the underlying company didn't change that much in the positive, and it didn't change that much in the negative. Companies change slowly, but share prices can move quickly, and that's what momentum traders are looking at.
So I think if we reflect on sort of how we started our investing journey, we came across value early on and thought that value was the way to go. Then we started learning about growth and trying to pick companies that were going to shoot the lights out. I've even dabbled in momentum over a period of time. And I think to take it to the higher level, we both now also have a passive and an active approach, which we'll talk about a little bit later. But the point really is that there is no right or wrong here. There is just, I guess, those key styles to be aware of. And have a play with all of them, get to understand who you are as an investor. Good news is you don't need to really understand any of them except passive, honestly, at the end of the day, because if you're a passive investor over a long period of time, and we'll give an example again a bit later in the series, it is more than enough.
So a couple of key takeaways from this episode. The first one is when you own shares, you are a part owner of a business. And the second thing is when it comes to the share market, there's plenty of ways to make money. Now, if you know someone that would like to make money in the share market, whichever style they choose, share this series with them. We're really passionate about engaging more Australians in financial literacy and helping them take control of their financial future. And it's only with your help and spreading the word that we can do this. But Bryce, that'll do it for this episode. We'll be back for episode 5 where we unpack what we can actually invest in.
Sounds good.